My guest today is Jack McCarthy, co-founder and CEO of Goldleaf Farming, a company quietly building one of the largest specialty crop platforms in the United States. Jack has raised over $250 million, bought and developed thousands of acres of almonds, pistachios, and dates, and runs his farms with the discipline of private equity firm and the heart of a multi-generational farmer. Thanks a lot for coming to the podcast, Jack.
Thanks for having me on.
I know you started all this back in 2017 and where you are today, and then we will go in detail of how you've done it all.
Awesome. Yeah, we're hoping to build a great agribusiness, sort of hybrid between an investment firm and an operating company that's focused on agriculture. Today we look like a large almond and pistachio farmer, and we think over time we'll continue to improve that business, make it more differentiated versus other growers, and then also to hopefully diversify. That's sort of emulating great businesses in our industry like Driscoll's or Wonderful or Cargill that maybe started a long time ago as a small grower and then made their businesses more differentiated and more diversified over time.
So the first acquisition was back in 2017, but could you maybe share more of your background? Because this is very interesting. I was doing the research, and how did you end up working together with your co-founder, Brandon?
Yeah, so we started the business in 2017. Before that, I was a consultant at McKinsey. I did a stint in politics in Chicago, and then I worked at a private equity firm, TPG, in San Francisco. And kind of through all those experiences, I think I was drawn to less sexy industries, like more overlooked old school industries, kind of like agriculture. It tends to be. I grew up in Indiana. My dad ran a construction company when I was growing up and still today. And, I think I just always got along well with the people in these industries. I think I was drawn to some of the like underappreciated and cool aspects of them, like the scale at which they operate and the impact they have on the world sort of more quietly than consumer brands or tech companies that tend to draw in a lot more attention. And so when I got to business school, I went to Stanford, and obviously there's a lot of entrepreneurial activity there, a lot of people focused on tech, particularly tech that they're going to use in their daily life. When I was there, it was like the era of like Instagram and Snapchat and just past like the Uber and Airbnb era. And so people were thinking about businesses like that. I was particularly drawn to kind of using that same environment I was in around, tech and new ways of doing things, but taking it to an older school industry like agriculture. During school, I met a classmate whose dad was an almond grower named Larson. And the two of us spent about a year with a couple other classmates thinking about kind of ways to use technology in agriculture. Ultimately couldn't find a business we were excited about building, but I did realize kind of how much opportunity there was in agriculture, and that's what led me to found Goldleaf in my second year of business school.
I heard a story where you shared that you had at the university you had Wednesdays off, and when the other guys went and played golf, you went to see almond mill. Like for how long did you do it? And as we can see, you were already curious back then.
Yeah, I mean, I think, one of the cool things about Stanford and I think business school in general is you have obviously your class obligations, but you're a lot less busy or sort of like mandated to be doing things than when you were working before. So, I was working a lot before in private equity and at McKinsey, and then I had quite a bit of free time and really chose to spend a lot of that on like giving a real shot to off the beaten path opportunities. I thought I had a great option in going back to TPG and really was really planning on doing that.
Quick break. What actually drives the best results post-acquisition, or if you're running a business? It's leaving your ego at the door and plugging into a proven process playbook. I know two brothers who did exactly that. They joined the peer group, followed the manual, and grew their portfolio from 9 million to 150 million. That's the power of process plus peers. And earlier this week, I spoke with Rand Larson. He's the CEO of ScalePath, and he's also the sponsor of this podcast. He built a network of 2,000 business owners, and every month he shares raw, real stories and hard-earned insights from the community, like the specific reason one founder finally decided to sell his business, even though he was doing like 40 to 50 million in sales. And what was the biggest lesson was that small business ownership is tough and unpredictable, so you need honest feedback loops. So if you're a searcher, a business buyer, business builder, make sure you subscribe to the ScalePath newsletter for behind the scenes look at what it's like to run and grow a business. And one recent member grew their business from 2 million to 10 million. Join at scalepath.beehive.com. That's scalepath.beehive.com. I also put the link in the show notes. Go sign up, go read, go learn. And now back to the show.
But for some like breakout opportunity to start my own thing or do something really off the beaten path. And so I spent a lot of time with, my friends that I was working on these tech ideas with and other ag ideas, basically going to meet growers, going to meet processors, traders, exporters of these more specialty commodities, and just like really trying to adopt the lean startup type methodology where you're like interviewing people, understanding their pain points and problems, and trying to solve them. And I think that kind of iterative process was really fun and interesting. And like, I just learned a lot about the industry. It didn't end up applying to a tech idea, but it still, has been helpful to this day in terms of just understanding like all, pieces of the industry and the different players. Yeah. So the first year of business school, I was really focused on this tech, like ag tech ideas. And we spent a summer on it, even like instead of getting an internship between first and second year, we worked on that full time in a venture firm's office. And basically just decided we couldn't find kind of a there, but we had met all these people, including two guys who became our first investors, Brian and Scott. And basically, they are tech entrepreneurs that happened to buy some farms as an investment. And so, we met them, we were talking to them about different technology ideas, which obviously they understood really well and thought they could give us good feedback from a farming standpoint and a tech standpoint as owners of some farms. And basically they suggested like when it wasn't working out, Brian called me and was basically like, how's your tech thing going? We were like, not good. We're going to shut it down and do something else. And one idea he had that was similar to what we were working on was like, why don't you just buy some farms and use, for example, new ways of farming, technology, things like that to do a better job at it. And there's sort of a whole investment model potential here where, if you go to real estate, it's very common to raise money to buy a building and own and operate, whether it be office buildings or apartments or industrial buildings. Like people commonly do that. In farming, most farming operations, the farms are owned by the family themselves, and there's not a lot of flow of capital in from outside the industry. And so that was the other piece. So basically, kind of entering my second year, Brian had called me and planted this seed. I had met Brian and Scott. They then introduced me to Brandon as, knowing that I wasn't from a farming background, would need some help on that front. And the four of us started looking at farms to acquire. And probably by, halfway through my second year, I was spending a lot of time like actually diligencing different opportunities that we were finding with Brandon and Brian and Scott, and kind of bought my first farm in fall 2017, so maybe 4 or 6 months after graduation. And, basically, you know, as I was starting to do that and the opportunity became more real, I had a farming partner. I had some interesting business opportunities to pursue in agriculture, and then sort of capital from these first investors. That's when I decided, hey, like this is real, and I'm gonna make the leap and quit TPG. And I ended up having to basically take out a bunch of student loans, wire them money because they were paying for my school, and tell them I'm not going to come back, which was a very difficult decision, but I think ultimately has been the right move for me.
You've said before that on the first year you invested like 2 million of equity, second year 8 million, third year 20 to 30 million, and the last one I found was 2023 was like 250 million of equity. So the growth has been very fast. But how was the maybe process and the lessons after the first acquisition? Like, okay, this model, what we want to do works. Should we buy more? Should we expand this? Like, how does it all work? Because it's not the typical like a service business or HVAC business. Like, how did it all go from there?
What was working at the beginning was finding good assets to buy with good water, good growing conditions, the things we care about. Um, you know, we felt like the crops we were in or have good fundamentals, good places to be. Um, what we've learned is so much about the operations. Like, we basically we're buying existing farms, but building a brand new operating business atop it. And that took really a lot of time. And I'd say not until we got into like 2023, 24, were we really doing a good job on the operations. And that took, experience, hiring. It took kind of building good processes, good systems, things like that. That, if you buy, for example, in a search fund context, an existing HVAC business, they have at least a start to all that stuff. And so we were almost like a startup combined with a search fund where we had to really start everything from zero. Um, so that was one of the lessons, is like really leaning into the operations, and we've done a lot of that the last few years. Um, Another lesson is just like the way that we built the thing was more deal by deal, so farm by farm, and that maybe was good from a fundraising standpoint. Each one was a discrete investment opportunity, but way too difficult, at least in this business, to operate. So if you think about, again, in a search model, people are gonna maybe buy multiple businesses in the same profile over time. They're not buying them as separate standalone balance sheets with separate financials and separate capitalization. Walmart, for example, isn't however many stores they have of independent companies, like they're all under one corporate parent. And yes, they give a lot of operating authority to their store managers and regional managers, just as we do, but they run it as one single thing. And so as we've gotten bigger, we've definitely tried to operate more of that, single company kind of model. And I think that served us and our investors really well, but it took a lot of work to transition our investor base from lots of small deals into one really main deal that we'll have for good here. And then, I think there's been tons of other lessons learned. Like, we've gone through a really deep drawdown in the almond market the last few years. Like, basically, these crops are really cyclical. They go through times when they make a lot of money, price is really high, and then times when they make no money or lose money, and price is really low.
Why almonds and pistachio?
We think both of these crops are really interesting from a lot of standpoints. One is that they require really specific growing conditions. So, they both require a Mediterranean climate. Most Mediterranean climates, there's not a lot of them in the world, and most of them are very arid, and so they don't really support agriculture. We're lucky in California that we have this great Mediterranean climate that's, hot and dry in the summer, and gets cool in the winter. But we also have the Sierra Nevadas to our east, so we capture all the snowpack in the mountains that feeds down the rivers into the Central Valley where we farm and everybody farms. And that's just a really unique global situation. So that translates to about 80% of the world's almonds are grown in California and about 50% of the world's pistachios. Basically, they're both crops with constrained supply, pretty good demand, and where growers over the long run have made good returns because of those conditions. And so we think if, sort of smaller growers have been able to earn good returns, if we go build a great business in these markets, we should also be able to earn great returns, or hopefully even better than the sort of long run average. So that's the theory, is like kind of being in the right markets that are still going to be the right markets in the long run gives you the runway to build a good business and have that sort of effort and time and money invested into building a great business pay off.
How do you value those farms?
Yeah, really, like, I think our market as a little bit more niche, like off the beaten path market, tends to think about price per acre. They think about the comps. And so, an almond farm is worth 25 or 30 grand an acre. The way we think about it is much more based on cash flow and cash flow production. And so that's more of like a DCF or, sort of real estate or private equity type valuation mindset. So we're going to look at things like, how much do we think it can yield? What do we think the different, scenarios are in terms of what commodity price will be over the next 5 or 10 years? Right now, we think commodity price is pretty low, but given sort of reductions in supply, we think commodity price is going to cycle up. And so that will change the next 5-7 years of cash flow. And then we're going to know really precisely like how much it's going to cost to farm, because we already farm in that area and we know like our actual spend. So we're sort of like building a P&L based on the farmer's production of how much cash he's going to produce.
Another quick pause. Today's show is brought to you by Spacebar Studios, and I'll keep this very short. 2 out of my last 3 guests, these episodes aren't even live yet, told me the same thing. If you actually want to grow a B2B newsletter, Brandon is the guy. I also heard it from a founder running a 25 million e-commerce company. Brandon's the co-founder of Spacebar Studios, by the way. And here's the headline. If you want to grow your B2B business, start with your inbox. Spacebar builds newsletters that drive pipeline, build authority, and generate real revenue. And they're putting skin in the game. The first 6 founders who raise their hand get their newsletter built for free. If that's you, reserve your slot at spacebarstudios.co/inquire. Again, spacebarstudios.co/inquire. Links in the show notes. Now, back to the episode. As you said, first year you invested 2 million of equity, second year 8, third year 20 to 30. Maybe you can share different phases of how you were able to put it all together, because I don't know too many people who invest in farms. Like how has been the whole process?
Yeah, so I think we started out more friends and family, like my parents and my old bosses and these 2 original investors, Brian and Scott, and some of their friends. And I think that was really like the first several deals was a lot of friends and family and their relationships. And as we kept going, we met more people, family offices and multifamily offices that said, oh, that's interesting. Like, we're looking for diversifiers, things that are not like more of the same types of real estate that we already have, or the same types of stocks that we already have. And because we were, offering this basically investment product, they were drawn to that.
You mentioned having investors who are aligned with you and your team. How easy or hard has it been when it comes to finding those investors, educating them of what you're doing? And in some cases, maybe you can share like how long has it taken for you to prove your track record, because you've gone through a pretty fast growth when we look like you started in 2017 and where we are today.
I think the alignment is about kind of shared values, finding investors that have the same values we do and like the same orientation around how long term are these investments. We don't want people who think they're going to get their money out in a year or two, because that's really not how farming works. This isn't sort of like a buy and flip type of business. We want people who think about being a great employer and a great steward of the sort of water and resources that we have. We want people that value that, because we value that, and that's how we operate. And eventually, it's going to cause misalignment if our investors think about things one way and we think about things another. All my money is in the business. Hopefully, none of our investors have all their money in the business. They have a small portion of it. So I'm going to care about this a lot more than they do, and really feel it more than they do. But that creates a lot of alignment. We also have lots of our team who are co-invested in the business, and every single team member has an equity grant in the business. And so from me to the guy driving tractors in the field right now, everybody thinks of it as their farm and their business, and not just like some passive investor. It's not their money; it's all of our money that we're managing, and all of our business that we're running together. So, we're really set up as an investment firm with an operating company, with a single farming company below it, and there's a few of us that are paid by the investment firm. That there's a management fee that comes in for us to oversee the investments, and we take out what we need from there. But most of the team is part of this operating business, and basically, I think because we have this investment function, we can raise capital, add capital to the business when we need it. We think like investors when we're adding farms or making major investments in capital projects, things like that. So we try to think like investors and leverage what we can in terms of being able to raise equity and debt that the business needs. And then I think, generally, like the idea of having hard assets that produce real things in a world that's sort of increasingly digital, and therefore things are getting disrupted really quickly. Like, there's not a different way to grow food. You need good land, water, and good growing conditions to do that, and that's exactly what we offer. So I think there's a good like Jeff Bezos quote about like everyone's always talking about what's going to be different in the future and trying to build for that. Nobody thinks about what's going to be the same. And sort of our business is built around like what's going to be the same in 30 or 50 years. Is like, we're producing good quality food at a low cost structure, and delivering that product to people that need it. And, that creates a lot of value.
Back in 2023, you've said that most checks are under 1 million, and you've built this large diversified LP base. What are the advantages? What are some of the hidden challenges of that type of structure versus maybe having fewer larger investors and tickets?
When everything's going swimmingly, that investor base, it's amazing. Like, they want a long-term investment. Like, they are not always that, at least our investors are not always that interested in like exiting things tomorrow. They want to sort of get their money invested in something attractive and let it compound and throw off cash over time. And so that's perfectly lined up with, how we want to run the business and really what works, frankly, in farmland. Like, there's not examples of farming and agriculture businesses that were built over 5 or 10 years. Like, most were built over decades or even centuries. And so we really want that long-term capital, and high net worth and family office capital is exactly that.
You've said having those conversations with your team about whether it's time to grow, whether it's not time to grow. Obviously, in the first years, looking at the investments, you've grown a lot, but where are you today based on when it comes to growth? Because you said before that it's painful time to be an operator, but good time to invest. So where are you today with your portfolio?
Yeah, we haven't grown that much over the last couple of years. Like we've basically been investing a ton in our operation to really strengthen our operation, building our balance sheet with the help of our investors. So we have the flexibility to operate through the rest of the low period. And then we're starting to build sort of firepower to be able to grow because we're starting to see, we think, the almond market turn, and get a lot more attractive just as there's not enough capital coming in, and it's probably getting more attractive because there's not enough capital coming in. So, the last couple of years we've been less focused on growth, more focused on really good operational performance, building balance sheet. And as we start to think about what comes next, there probably will be some growth at least, because we think there's a really good moment to grow, and we have more confidence in the business that we have.
So back in 2023, you shared these are you've openly said that you had like 250 million worth of equity value, and the rest 100 million was debt.
Yeah.
Total assets were like 350 million. Has it changed? Because you mentioned Buffett and Munger before, like when it comes to risks and your approach. You mentioned you're like less towards raising lots of debt.
Yeah, we probably are a little lower on debt and a little higher on equity, and or I think in general moving in that direction where for some projects like we're not afraid to use debt, but we really want for our mature farms to have very low cost of production, like their cash break even point to be really low, because that's what gives us advantage over other growers. So we need high yields to manage our costs tightly, and then basically not to lever very much, because that adds cost of production. Even when you've got a low price year, you're still going to make a debt payment.
And acres wise, you are at 12 to 13,000 acres, right?
Yeah, we're a little under 12,000 acres. Yeah, planted.
And for people to understand, how large is this whole area?
San Francisco is about 30,000 acres, so we're 40% the size of San Francisco. And then another common thing we throw out is that Central Park is around, I think, 800 or 900 acres. So we're 15 or 20 times the size of Central Park. So we're a big grower in these crops. If you go to people that do cattle, like what you see on Yellowstone on TV, or people that do corn and soybeans in the Midwest or in other parts of the world, those businesses are much more broad acre. Our more specialty crops, you can make a lot more money per acre, and so you're not as large, but we're still operating a really massive amount of land, and certainly relative to like where you live in a city or a town, like the acres we're talking about are really, really substantial.
And team-wise, it's around 80 or 90 people, right?
We're around 60 people today. Yeah.
60 people.
Yeah.
Okay. What are the things you can mess up in what you do? Because this is something you mentioned in the early on. Like what are the risks, what are the challenges, and what are the things you can really mess up?
California and sort of globally, is there a really good overlap between water and growing conditions that's going to allow kind of the most optimal climate for a given crop to grow? And that translates economically into higher yields and a lower cost per pound or cost of production, which is sort of like the same thing as if you're in the oil business or in the mining business, or if you're a retailer, you want to deliver things for like the lowest price that you can, the lowest cost that you can, to differentiate versus other operators. For us, the way to do that is really, really good growing conditions. So that's the first thing, is like buy the right farms that have good water, good growing conditions.
How picky you are and your team are when it comes to how many farms are you looking at, how many opportunities you're looking at, and how many you eventually close and move forward?
We've probably looked at 1,400, something, a lot of farms over the years. We've only bought, like I said, we have 27 farms, so we've only bought 27. So the hit rate's very low, 2 or 3%. We try to really see everything. but quickly pass on most of what we see based on really like not the right water or not the right, yields or growing conditions. Because we're really looking for very high quality farms that we can hold forever. Um, if we're going to do all the work to find a farm and then get it sort of onto our system and get it really well taken care of, we want to hold that for a long time. And we're not thinking about these as something that we're going to sell in 3 or 5 years. So
In the early days, you were growing very fast, and you previously mentioned maybe sometimes even too fast. Have you made like any acquisitions where the farm you bought, you thought that it's going to be a good one for the obvious reasons you brought out, the water and the climate conditions? Have you had any which turned out to be not so good? And if that has happened, like how do you solve it? Like, do you get rid of that, or there is still something you can do to to make it better?
fortunately, we haven't had any like catastrophic issues, like where we just like it's an intractable problem that we can't solve. Like, I think our biggest mistakes have been probably before we learned these lessons that I'm talking about to you now, 5 or 7 years ago when we were first starting. I was coming out of private equity. And so I was more focused on kind of um, what's in the Excel model, like the entry price and, you know, things like that. And so, at the beginning, we were probably more focused on, um, what are the returns we can get? Therefore, how cheap can we get an entry price? Are there structural reasons why the entry price is going to reset? Things like that. But I think now I'm much more focused on like really paying attention to the quality of the water, paying attention to the quality of the growing conditions, and that ultimately is going to lead to a higher quality asset. And even if we paid a higher price, the performance is going to be better because that asset's going to produce through the cycle. It's going to be much easier to run, and our team is going to be freed up to therefore improve it rather than kind of working really hard just to maintain it.
Now, for you personally, looking at those overlooked businesses has played out super well. You found your niche, you become an expert at this, you build a large company, hiring a lot of people. What is maybe it's like a general advice to someone listening who might think the same way that their opportunity might be in these overlooked businesses, but they maybe don't know exactly like what to do or where to look for. What would you do knowing what you know now? Like how big an opportunity could be in this very specific niche, like in your case, agricultural, and going even further, it's like almonds and pistachio. It's like a huge business you built. So maybe some some advice because it has played out very well for you.
I think so that mindset of just like constantly trying to be a little bit better the next day and the next month is a big part of what I would say. And then, I think the other thing is like um both be ready for a long slog. And like I think the best way to attempt something entrepreneurial is to think about it over the long haul, because it is going to take more time and more money and more effort than you imagine. But at the same time, do it, because I think I've had some of my most fulfilling personal and professional opportunities come from this. I've learned a lot. I've grown a ton. I've been put through really, really hard things, but I'm better for it, and I'm really glad that I decided to go down this like more off the beaten path. So I think it's a constant evolution. You're not going to, achieve things overnight, and it's going to be hard. But if you kind of go in with the right mindset of like, hey, like let's do this over the long run. Let's prioritize the right things, like behaving ethically, working with good people, building a good culture. Like those things do pay off, and especially if you go in with that kind of longer term mindset.
I have a personal question to you. Like
Yeah.
I have two kids. If I'm right, you have four.
Yep.
So my question is, how do you manage it all? Because you're living the life. It's super awesome. But four kids, that's a
A
lot. I can
lot.
say that. So how do you manage it all?
I think like I talked about our culture. Um, one. thing is the high ownership. Like that's a big part of our culture. Another of our four values is act like an owner, be candid, put family first, and lead by example. So I didn't talk yet about the family first aspect, but that's a big part of what we do is like we want to be able to prioritize what's really important in life. Like, I think obviously it's really important to me to do a good job for our team, for our investors, to build a great business, but it's not as important as being a good dad and husband. So um, I definitely have to keep that in mind, and I want our team to keep that in mind. Like, no matter how serious the problem, we all have bigger things in our life, and so that's really important to us. And we, part of the way we set up the company is, um, we want everybody to be able to prioritize that. So we have parental leave for new parents, whether you're me or you're a tractor driver. Like, we want people to be able to be off and be present with their kids for that like extremely fleeting moment. Um, my kids and my whole team's kids have the same exact healthcare package, so like everybody's taken care of in the same way. That stuff's really important to us, and I think one of the nice things about in my personal situation is like I probably would have made more money at TPG or had a more high flying career for sure, but I also would have had less flexibility and ability to work my kids into my life. And one of the awesome things about being an entrepreneur is like when I go to the farms in the summer and my kids are off school, I can take them with me. Or, we don't have Labor Day off as a company because it's right in the middle of harvest. But obviously, most kids have Labor Day off. And so our sort of company tradition is everybody in the office brings their kids out to the farms, and then we sort of hand out, drinks or ice cream or whatever to the guys because they are out there working hard in 90 or 100-degree heat. And it's a nice way to show appreciation and sort of show our kids like what our company's all about.
What is the best investment advice you've ever received, and what is your favorite book?
Something around like the desire to continue learning and to be curious. Like I love the Charlie Munger thing about like the best teachers are the eminent dead. Like reading, biographies of great people costs you 10 or $20 to buy a book on Amazon, and you can learn all about somebody who had like a massive impact on the world and had a bunch of unique things about them that you can like really tangibly pick up. So I love uh, the encouragement to learn and to always sort of be like a learning machine and keep reading and learning and talking to people and picking up new information over time. So I think that's probably like great life advice, but also great investment advice. And then I think favorite book, I'd probably say East of Eden. Like I love the sort of like John Steinbeck stuff around like California and its origins, and sort of a lot of it is related to what I do in agriculture, and sort of talking about like the foundations of uh, you know the business I'm in, but also like the community that I inhabit, and kind of like general humanity and the thoughts on ethics and how to be a good person. So I love Steinbeck, and I love that book in particular.
Jack, I'm very happy that I got to talk to you. You have to say thank you for your team as well, because
Yeah,
setting everything up was very easy.
great.
They were super fast and professional. And yeah, thanks once again for doing this. More than happy to do it again in the future to see where you've grown this company. And again, thank you for your time.
Yeah, thanks so much for having me, Mick, and nice to be on, and appreciate everybody listening.